What's up guys, it's Lili here. Today, I'm not only copying Graham Stephan's intro and asking you to smash the like button for the YouTube algorithm, but I'm also responding to a video he made titled, "The Housing Market is Out of Control." Like a lot of you guys, I like watching Graham Stephan, not just to see, the Tesla that he bought for $0, the duplex that he bought for $0, but also get an understanding of how someone who made millions of dollars feels about the housing market. But at the same time, I want to respond to this video because someone who's already made millions of dollars investing in real estate probably has a different position and perspective on what people who are trying to make their money in real estate today should be doing. So if you're down for that, smash the like button for the YouTube algorithm. Let's get started. By the way, before we dive in, if you guys are new here, my name is Lili, and this channel is where I've been documenting my real estate investing journey from literally owning no properties to now owning my own property that I live in and house hack, as well as wholesaling multiple properties. And I'm in the process right now of flipping my very first house. So I really do want to share just a beginner perspective of the stuff that Graham is talking about here. I haven't watched this video yet, so I have no idea what he's going to say. Let's dive into it together.
What's up, Graham? It's Guys here. So it seems as though every few months there's a new major shift in the housing market that continues to push prices further and further ahead. And this week we might very well have a catalyst that would completely change the landscape for real estate, where if you thought it was expensive today, just wait. Like over the last few months, we've seen housing inventory plunge to its lowest level in recorded history. There are now 40% fewer homes on the market today than they were a year ago. Prices have risen at their fastest pace in 15 years. And as a result, a lot of would-be home buyers have been completely squeezed out of the housing market. Seriously, in just the last year, national housing prices are up 11%, which means some areas are seeing even higher than that. Like where I'm living in Las Vegas, that's up 14%. And Idaho, which is currently leading the entire country, is up 22.6%.
I would have never guessed that Idaho was leaving the country in terms of, how quickly housing prices are rising, but you learn something new every day.
I have been in real estate full-time over 12 years as both a real estate agent and real estate investor, and I have to say, this current housing market is one of the most unbelievable spectacles I have ever seen, because it's driven by a perfect storm that just keeps pushing prices higher and higher and higher, and then we have today. It's a brand new proposal that would extend mortgage forbearance and allow homeowners to extend their mortgage for as long as 40 years. Meaning if you have 20 years left on your mortgage right now and you're in forbearance, you could potentially turn that into a brand new 40-year mortgage. And guaranteed if that happens, housing is about to get a lot more expensive.
Okay, so if you're not sure what mortgage forbearance is, I learned about what it was at the start of the sickness and the lockdown last year. Basically, if you can't pay your mortgage because of some type of financial situation, you can apply for forbearance, which basically pauses your mortgage payments and allows you to pick them up when your financial situation improves. And so without penalty, without, dinging your credit or, accumulating late fees, basically pausing your mortgage. Now, I may have heard him wrong, but forbearance for 40 years sounds insane.
So let's go ahead and break this down even further, and I'll explain exactly what's going on, why this is happening, what could come from this, and then I will give you my own thoughts as both a real estate agent, a real estate investor, and as someone who's always going to remind you to extend that like button for 40 years by making it turn blue for the YouTube algorithm. That's all I ask. It takes you just a quick second. It's totally free, and as a thank you for doing that, here's a picture of a really cute squirrel. All right, so here's what's...
I'll put an even cuter picture of a really cute squirrel up right now. Hit that like button.
Caused this perfect storm of a situation to happen, and why real estate prices seem to be doing absolutely nothing but going up. It all began on one mildly warm, partially cloudy day of March 15th, 2020, when the head of the Federal Reserve, Jerome Powell,
lowered benchmark interest rates all the way down to 0% in an effort to stimulate the economy.
All right, I'm not going to keep up that voice for the entire time, but here's what's happened. When everything shut down, there was the major concern that everyone would immediately lose their job, they would stop spending, they would stop paying their loans, they would default on their loans, banks would stop lending money, and the entire financial system would come collapsing into the abyss if nothing was done. So interest rates were lowered to incentivize people to borrow, spend, and lend more money. And that in turn would help people stay afloat during a very difficult time. Then shortly after, the CARES Act was passed on March 27th, which allowed homeowners to apply for mortgage forbearance, and that would allow them to temporarily pause their housing payments for up to an entire year. In conjunction with that, evictions and foreclosures were put on hold. And the goal was that if we could just get through through this next year and reopen the economy, we'll be able to get through all of this okay and continue on as normal, except, well, no. As a result of lower interest rates and cheaper borrowing, nearly every investment out there has skyrocketed in value.
So if you're not quite sure exactly how interest rates affect prices, it's because the lower the interest rate, the more someone can afford to pay for a property. So let's imagine that you're gonna get a loan for a property for 30 years, that's the typical mortgage, at 4% interest, right? 30-year, 4% interest, you're buying a property for $200,000. Well, your monthly payment is gonna be this much. But if you were, instead of being at 4% on that 30-year, $200,000 payment, you were at 3%, then your monthly payment would be this much. See the difference? So that means that not only will I pay less per month on that $200,000 purchase, I can instead start offering $205,000 or $210,000 on a property because I know my payments are still gonna be lower than if I had that higher interest rate. So when those interest rates went down to literally zero, people wanted to buy because they could afford to buy a house and have lower monthly payments that they wouldn't have been able to afford if the interest rates were higher.
Low interest rates have made real estate more affordable to purchase, and as homeowners get qualified for a larger loan with a lower payment, that in turn helps push up prices. Now, ordinarily, you would think that this could only go on for so
I really like the way you put that. Larger loan, lower payment. That pretty much explains it.
long before prices come down and things begin to stabilize. But with this new proposal, housing prices could get another push even further. And this now is what's beginning to happen. Right now, there's currently the concern that 2.5 million homeowners are under forbearance, which means they're temporarily not making their mortgage payments and they're protected from foreclosure. There's also a surplus of tenants who are unable to pay their rent, and the worry is that if evictions and foreclosures all happen at the exact same time all at once, that would cause a very sudden and drastic economic hardship for millions of people, and that in turn would be detrimental to the entire economy. So in an effort to provide people with enough runway to get back on their feet, a brand new proposal was just issued by the Consumer Financial Protection Bureau to be effective on August 31st, 2021, and here is exactly what that would entail. First, this would only be applicable to a homeowner's primary residence, so investment properties would not be able to qualify for this. Second, this one would be open to anyone who attests that they've experienced financial hardship due to the illness. The definition of this is a little bit loose, so it's really up to the homeowner's discretion to decide for themselves whether or not they've been negatively impacted. But if so, the lender needs to listen and offer what's called loss mitigation. This is the process in which a lender will clearly run through all the options the homeowner has to stay and keep their home. That might include a loan modification, an extension on payments, or working out a payment plan so that the home doesn't fall into foreclosure. But third, here's where things start getting really interesting. This proposal would allow for a loan modification that would give homeowners the option to extend their loan in forbearance by no more than 480 months, which is 40 years, all without an increase to that person's interest rate. Now, just to give you an idea of how significant this is, on a 15-year mortgage at $250,000 at a 3.5% interest rate, your mortgage payment would be $1,787 a month. But extend that to 40 years and your new payment is now $968 per month, which is almost half. On top of that, fourth, if any portion of your loan is deferred, you would not owe any excess interest and all fees would be waived. This is really as thorough as a pause as possible. It's as though you're just getting a completely free loan for as long as the forbearance period is active, with the option to extend that loan for up to 40 years as soon as you begin making your payments. And finally, fifth, this must be available for anyone experiencing financial hardship, which again is defined by the homeowner. Right now, there's really not a clear distinction as to what's considered financial hardship and what's not, so everyone is put in the exact same category, whether they've been out of work for the entire year or whether they're making $500,000, but that was a 30% decline from the year prior.
Okay, so one thing I want to say is that this obviously seems like a huge benefit to homeowners, but renters are still kind of left out to dry. And this is one of the reasons that I really feel like you got to own your own house. You have to own where you live, whether you're house hacking it or whether you're just living there, because the way that the system is set up is that the government is going to benefit homeowners over renters, right? Renters are at the mercy, really, of their landlord, the person who owns their property, one, to, be reasonable with the amount of rent that they're charging them, but two, also be understanding if they have missed payments due to, the illness. Because even though there is an eviction stay right now, renters still can get evicted once that is lifted, and you never know when it's going to be lifted. But with forbearance, you are, having up to 40 years to pay that money back or to extend your loan. And so it's just a situation where you are much more protected if you own your own property. And it's kind of makes me think of the debate about credit scores, where when you pay your mortgage, that gets positively reported to your credit report, but when you pay your rent, it doesn't help you at all in terms of credit score. So it's just so many reasons that it's unfair, but if you're going to take matters into your own hand, it really is beneficial to own your own property.
And really, who's to say what is and what's not financial hardship for your own situation? So really, at the end of the day, they leave this up to you to decide. Then to top it all off, if a homeowner is going through foreclosure, this would extend the filing deadline by an additional 120 days until December 31st, 2021. So in this case, homeowners would be able to get an additional 4 months worth of runway to figure out their situation, whether or not they sell, or whether they try to get a loan modification, or figure something out before they get foreclosed. Now right now, this is just a proposal open for public comment until May 10th. But if this goes through, this could be another major catalyst for the entire real estate market, with some major implications for anyone looking to buy or sell a house. But before we go into the fate of the real estate market, real talk here, this isn't sponsored or anything, but I recently invested in a company called Public. And they're a completely free stock trading brokerage combined with a social media aspect so as to create a community of like-minded investors who all just want to help each other out. I like the fact that it was a platform based around long-term.
We're gonna fast forward.
Take an objective look at what's going on with the housing market and where we might be headed from here based on data and science. Okay, there's actually no science, but let's talk about the data. In the last few months, the yield on the 10 and 30-year treasuries have started going up due to increased concerns of inflation, and that in turn has continued to push mortgage rates higher. That just means that as mortgages get more expensive, buyers are able to purchase less house, and that in turn might bring down housing prices. But
so what we were talking about with interest rates being really low, I think he said lower payments, larger loan. Now as the interest rates go up, because people are worried about inflation, meaning our dollar becoming worth less because we're printing so much money, then the interest rates also go up, which means smaller loans, larger payments.
No, that's not happening. Prices keep getting pushed back up for two main reasons, and the first is that housing inventory keeps getting lower. We're at the lowest level of housing inventory ever in history. Like for reference, in March of 2017, there were almost 1.3 million homes active on the market, but today there are only 493,000. That means with less inventory, buyers are forced.
If you guys are wholesaling or looking for a property to buy, you probably have felt this. Like there used to be so many houses on the market, you can make offers, they weren't selling because, they weren't in great condition and you had kind of the pick of the litter. But now, because there's so few houses, people are like, look, I don't care if the carpet's ugly. I don't care if the paint's bad. I'll fix it myself. I just need to buy a house. And so more competition, higher prices.
In turn drives prices higher. And second, with interest rates going up, buyers are rushing in right now to lock in a low interest rate while they still can. The expectation today is that over the next few years, mortgage rates are going to get more expensive than they are today. So if you want to buy something, you better do that sooner than later so you don't miss out. Well, that is of course bound to rise prices even higher. Now, from a numbers standpoint though, in terms of the foreclosure crisis, things are actually improving. Even though it's definitely super spooky to see articles claiming that 2.5 million homeowners are still in mortgage forbearance, that number has been steadily declining over the last 9 months, and it's fallen for the first time ever below 5%, which by the way represents the 4th straight week of a decline. This is a really good sign that homeowners are getting back on their feet, they're making their payments again, or they just took mortgage forbearance out of an abundance of caution because why not, and now they're making their payments again. However, all of that excess demand to buy a home ended up pushing up homeowner equity by $26,000 across the US in the last 3 months of 2020. Meaning that chances are, if you own a home right now, you've probably just made a lot of money over this last year. This also means that the likelihood of a home actually going into foreclosure today is relatively slim. That's because generally only homes without any equity go into foreclosure. Otherwise, it would be way better for the homeowner just to sell the home, rake in some fat profits, and then just move on. Well, of course, when it comes to this, it was found that only 2.8% of all properties with a mortgage were in negative equity, which is where a homeowner owes more on the home than what it's worth. And so even though you have 2.5 million homeowners in forbearance, less than 3% of those people are in actual risk of a foreclosure. And so as it stands right now, interest rates are still historically low. Inventory is still incredibly low.
If you've heard someone say a mortgage is underwater, that's kind of the same thing, negative equity. So if they owe $100,000 on it, but it's only worth $80,000, then they're underwater.
Homeowners have more equity than ever before, and a surge of demand is the perfect storm to keep pushing prices even higher. But when it comes to my own thoughts on this as both a real estate agent and real estate investor, and whether or not something like this is actually sustainable with a 40-year mortgage, here's what I think. Based on the numbers, I don't think there's going to be a mass foreclosure crisis based on the data that there's just not that much to foreclose on. Like in 2009 during the Great Financial Crisis, that was a different story. Homeowners back then took out adjustable rate mortgages on homes they couldn't afford with 0% down. So really right off the bat, as soon as they closed on the home, they had zero equity. Then when the real estate market tanked, they were completely underwater on their mortgage, having owed more than what the home is actually worth. So really in those situations, foreclosure is the only course of action. Today in 2021 though, that's not so much the case. Like in 2009, 25% of all homes with a mortgage were underwater. And like I mentioned, today that number is only 2.8% and dropping. Homeowners today do not have adjustable rate mortgages. Interest rates are at their lowest level ever.
So adjustable rate mortgage, kind of what it sounds like. If you buy it today, you might have a 3% interest rate, but as interest rates, with the Federal Reserve change, then your interest rate could go up or down. Those are really not that common anymore because of what happened in 2008. Today, if you buy a house, you have a 3.5% mortgage or interest rate, then that interest rate is locked in for the life of your loan. Whether other interest rates just in the market go up or down, your interest rate is locked in, which lets you know exactly how much you owe, which makes that loan arguably a lot safer.
Banks are only now lending to the most qualified buyers. And if a homeowner can't make their payment, they could sell right now at top market value and probably make a lot of money. Now the risk is that if interest rates suddenly start to go up and everyone lists their home exactly at the same time, that could absolutely be enough to trigger housing prices to come down. So if either of those factors change, it will have an impact. But realistically, will that happen? Well, I would say probably not both at the exact same time. From what I'm seeing, homeowners don't want to involuntarily sell their home, and if they're behind on their payments, it would just make sense for them to work out a payment plan and stay where they are. Plus, even if they do want to sell, where would they go? Every other area is now just as equally as expensive, so it's a wash in terms of how much money they can make. In addition to that, interest rates would probably continue going up, but I have a feeling it would be a very gradual increase that would give the market enough time to adjust. The problem, however, is that today we've artificially created a lack of inventory by holding back the sale of homes and foreclosures through policies that inadvertently boost up housing prices across the board. Here's another one of my homemade Photoshop sketches of what's going on. If housing is like a river, there's always a constant flow of people selling their homes who can't afford them, who lose their job, whose situation changes, and that supply feeds the market who wants to buy. But as you place mortgage forbearances, stop foreclosures, and allow for 40-year mortgages, what you're doing is placing a dam in the middle of the stream that backlogs supply. So now you have the same amount of buyers, but half of the homes there usually are, driving up the price. Then of course you sprinkle in some low interest rates into the mix, the buyer demand doubles, and now you have what the housing market is today.
Yeah, I really like Graham's take here, and I think that one thing is like to not stop here, right? To think about, okay, why are prices doing what they are, and what do I do next? Because, honestly, Graham doesn't have to work another day in his life. He doesn't have to ever buy another property. He doesn't really ever have to make another YouTube video. He's set. But if you're still, working to live, and you still want to get into investing in real estate, what options do you have? I think that the two strategies that I've taken advantage of so far, you can see a breakdown of those two right here. It's wholesaling and house hacking. So for house hacking, interest rates are really low, which means that if you want to buy a property, rent out the area, the space in that house that you're not living in, you could do that right now and afford a lot more house because interest rates are really low. So that might be an option that you want to take advantage of. But again, it might be hard to find a property because inventory is so low. But on the other hand, if you want to wholesale, your job is to go out and find those good deals. In the same way that homeowners who want to live in a property are scrambling for deals right now, so are investors and cash buyers. They're also scrambling for deals. Prices that wholesalers are making are rising. I had a student who took my 5-day beginners bootcamp who made a $70,000 wholesale fee. That could be a great way to get involved on what's happening in the housing market right now. So what do you guys think? The housing market is undeniably going crazy. Are you sitting out right now and waiting for prices to come down, or have you found a way to stay involved? Let me know in the comments. I appreciate you guys being here. As always, smash the like button for the YouTube algorithm, and I'll catch you on the next video.